Okay, let's unpack this. Today, we're doing a deep dive into Kinross Gold Corporation, specifically their third quarter results for 2025. And look, the big story here is how they aggressively capitalized on, well, frankly, soaring gold prices. The results are pretty unprecedented for the company. So our mission really is to dissect these numbers, understand what this cash bonanza means strategically, and check in on how their long-term projects are lining up with these huge capital return plans.
That financial strength, yeah, it's definitely the headline. This quarter, the one ending September 30th, 2025, it just shows the company firing on our cylinders, maximum operational leverage. They're not just making good money, they're hitting record cash flow, paying down debt early, and making some really big promises back to their shareholders.
And the number that just jumps out, the headline nugget right away,
Yeah.
it's the cash generation. Kinross hit a record attributable free cash flow of $686.7 million in Q3. I mean, that's a jaw-dropping 66% increase year over year.
Yeah.
Q3 2024 was what, $414.6 million? So maybe for the listener, what does attributable mean right there? Why is that distinction important?
Yeah, that's key. So, attributable free cash flow. Basically, it's the slice of the cash flow from operations that Kinross actually gets to keep. That's after you account for the capital needed just to keep the mines running, sustaining capital, and after you exclude any share that belongs to minority partners. So really, it's the net cash, the deployable cash that management has full control over. And yeah, seeing a 66% jump like that, it tells you the price environment is just translating almost directly into pure financial firepower.
Right, firepower that's had a huge effect on their overall balance sheet. The sources show that as of September 30th, Kinross hit a net cash position of $485 million. That's pretty remarkable.
It really is. Hitting net cash means the cash they have on hand, that $1.7 billion, is now more than their total debt. For a major mining company, crossing that line, well, it's a massive signal of financial health. Really strong. And you add to that their total liquidity, about $3.4 billion. I mean, they've basically built themselves a financial fortress.
Okay, and they're using that fortress, it seems, quite strategically, wiping out future obligations.
Yeah.
Tell us about that $500 million debt move.
Yeah, this was, you could say, a conservative move, but also a really powerful one this quarter. They announced they're redeeming $500 million in senior notes early. These are bonds they issued weren't even due until 2027.
Right.
So by paying them off now, using that excess cash, they've essentially kicked the can way down the road. Their next major debt maturity isn't until 2033.
Wow, 2033, that 8-year runaway? That's stability right there. So for the listener maybe tracking management decisions, what's the real practical benefit of clearing that debt so far out?
Well, it just massively de-risks their near-term planning. Think about it. Management doesn't have to worry about setting aside hundreds of millions over the next couple of years for a big principal repayment. They can take that capital and point it directly at growth projects, or, like they've chosen to do pretty aggressively here, funnel it straight back to shareholders. It's basically a clean slate operationally until the 2030s.
Okay, speaking of funneling cash back, that robust financial position, it's currently fueling some very aggressive shareholder return targets.
Oh, very aggressive, absolutely. Kinross is now aiming for $750 million in total shareholder returns just for 2025. And that cash is going back in two main ways: a big boost to share buybacks and a hike in the dividend.
Okay, let's take buybacks first. The 2025 target, up 20%.
Correct, up to $600 million now. And they've already been busy repurchased $405 million worth by early November. That's a huge commitment to reducing the share count. But, this does raise that classic question for you, the investor. Is management doing this because they think the stock's way undervalued right now? Or perhaps are they passing up chances to maybe reinvest even more in their existing mines, things that could yield even higher long-term returns?
Yeah, the eternal capital allocation debate.
Yeah.
But shareholders are also seeing immediate cash through the dividend increase.
They are. The quarterly dividend got a 17% bump, up to $0.035 per share. That's fillers and 14 annualized. When you see a company doing both things at once, paying down debt and massively increasing returns like this, it's a loud signal. It says they're generating cash faster than they can realistically spend it internally right now, and they feel pretty confident that their current growth projects are well-funded.
All right, here's where it gets really interesting. We've set the stage. The gold price was the engine. But let's look at the operational physics. How did that price actually translate into the margins?
Well, the price they realized was just monumental. In Q3 2025, the average price Kinross got was $3,460 an ounce. Just think back a year, Q3 2024, it was $2,477. That's nearly $1,000 difference per ounce. That jump is what just fundamentally changed everything financially for them.
And the margin growth that followed is, frankly, phenomenal. Because, like our sources show, it wasn't just proportional to the price rise, it actually grew faster. Their margin per gold equivalent ounce sold jumped 54% to $2,310.
Mm.
And the key thing here, that margin increase outpaced the 40% rise in the realized gold price.
Exactly. And that outperformance, that's the operational insight we really need to hone in on. It suggests Kinross did a really good job controlling inflation on the costs that aren't directly tied to the gold price. Their operational leverage is strong, so they could push that benefit from the higher price pretty much straight to the bottom line. That's a sign of really excellent cost discipline relative to the market.
And you saw that flow directly into net earnings, right?
Absolutely. Reported net earnings up 65% to $584.9 million or 0.48 cents a share. And the adjusted net earnings, which, often gives you a cleaner look at the core business performance, jumped 77% to $529.6 million or $0.44 a share. It's just powerful growth, really maximizing every extra dollar that gold price gave them.
Okay, now for the necessary balance check, the cost story. You often assume high gold price equals rising costs across the board.
Yeah.
What did the cost metrics tell us, specifically that attributable all-in sustaining cost, the AISC?
Right, the AISC, that's your sort of all-in cost to produce an ounce and keep the mine going long term. And yeah, it did rise significantly. Attributable AISC went up to $1,622 per ounce sold. That's up from their $1,350 back in Q3 2024. Production cost of sales also climbed to $1,150 per ounce for $976.
Okay, that jump in AISC looks pretty dramatic on paper. What was the main reason behind that increase? Was it inflation biting hard?
Well, the key detail, and this is important, the primary driver inflating those costs was actually higher royalties. Royalties are basically payments, often to governments or landowners, that are calculated as a percentage of your revenue.
Ah,
So that super strong realized gold price, while great for revenue, automatically triggered higher mandatory royalty payments. And those payments get baked into the cost structure into AISC.
so it wasn't necessarily a slip in efficiency or like diesel costs suddenly spiking. It was more of an automatic tax on success tied directly to the selling price.
Exactly right. It's a part of their cost structure that's just designed to go up when revenue goes up. But the key point is that high realized price was so dominant, it just easily absorbed those built-in increases. That's why the margins still exploded upwards, even though the AISC number itself went up.
Got it. Okay, let's pivot a bit from the financials to the actual production drivers. What's happening at the mines? Because despite the financial records, overall attributable production was actually down slightly year over year, about 503,000 gold equivalent ounces compared to 564,000 in Q3 last year. What drove that dip and, where were the stars shining brightest?
Yeah, that production decline, it was largely expected. It was tied directly to planned mine sequencing. So the company was pretty clear this wasn't some kind of operational hiccup. But you're right, two operations really stood out as just cash machines this quarter.
Paracatu in Brazil, I assume?
Yep. Paracatu was, once again, the biggest producer in their whole portfolio. Its success came down to geology. Basically, they were processing higher-grade ore and getting really strong recoveries in the mill. Just a solid performer.
Okay, and La Coipa in Chile. That showed a big improvement quarter over quarter too, right?
It did, yeah. La Coipa had a planned increase in production, and importantly, its costs actually went down. That tends to happen when you successfully transition mining into a more profitable zone of the ore body. In this case, they moved into higher grade stuff from Phase 7. Better ore means more ounces and usually lower unit costs. Win-win.
Okay, so if those were the stars, where did the planned production headwinds actually hit?
We saw the year-over-year production decreases, as planned, at places like Tasiast, Fort Knox, and Round Mountain. And Round Mountain, Nevada is probably the clearest example of that sequencing impact. They're in the middle of transitioning mining operations from what are called Phase W to Phase S.
Right. And for the listener, what does that shift, Phase W to Phase S, what does that actually mean in the short term? Why does production dip?
Well, it really comes down to the grade of the rock they're feeding the mill. Phase W, that was higher grade material, relatively easy to get at near the surface. Phase S is the current zone, this transition area, and it just meant the ore going through the mill temporarily had a lower grade. So when you process lower grade rock, you just naturally recover fewer ounces of gold. It leads to a planned dip in quarterly output. Again, planned, not a surprise or an equipment issue.
Okay, so they're managing through that planned volatility. How does that leave their overall outlook for the full year then? Are they still on track?
Yeah, they confirm they're managing it just fine. If you zoom out to the big picture, their 2025 guidance check, despite these planned Q3 ups and downs, Kinross is still firmly on track. They actually expect production to land slightly above the midpoint of their guidance range, which is 2.0 million gold equivalent ounces, plus or minus 5%. So, still looking solid for the year.
That operational execution sounds good. But, given they just announced these huge capital returns, the big question is, how are they justifying funneling that much cash back to shareholders while still funding the future?
Let's turn to the growth pipeline. What projects are coming through that really underpin that long-term value?
Yeah, that growth pipeline is absolutely critical. It's what lets them justify that really aggressive capital return strategy. And we are seeing some major tangible progress. Great Bear in Ontario, Canada, that's their big Tier 1 project. The Advanced Exploration Program, the AEX, it's moving forward quickly. Key infrastructure pieces like the camp and the natural gas pipeline, those are actually completed and commissioned now.
And on the permitting front for Great Bear, the sources mentioned something about a phased impact statement submission. That's right, and it's a crucial detail for kind of de-risking the timeline. They're pushing ahead with detailed engineering for the main project itself. And importantly, they filed the first of 3 planned phased impact statement submissions right on schedule back in September. Filing on time like that, it shows real commitment and helps manage that, often lengthy regulatory risk. It keeps the project moving steadily through the gates.
Okay, then we shift back to the U.S. to Round Mountain Phase X. That looks like the next major underground development for them.
It is, and it looks like a phenomenal target. The decline development that's basically building the underground tunnels to get to the ore, it's advancing really well. Over 5,200 meters developed already. And the drilling, the infill drilling they're doing, it keeps confirming the potential for a big bulk tonnage underground mine there. The source material highlighted some excellent results, like one intersect hit 56 meters, grading 5.8 grams per ton gold.
Okay, 5.8 grams per ton over 56 meters. That sounds really good, but maybe put that in context. Why is that specific grade significant for a bulk tonnage underground mine?
Sure. So in gold mining, big open pit mines, they often make money on grades around, say, 1 to 1.5 grams per ton. For an underground mine designed for bulk tonnage, meaning moving a lot of rock efficiently, anything significantly over maybe 4 grams per ton, especially over wide zones like 56 meters, is considered really high quality, potentially very profitable ore. That 5.8 result suggests they've found a really solid, high quality reserve down there. It helps justify the economics of building that big underground mine, justifies the money they're spending now on building those access tunnels.
Right. So when does the market get a clearer picture of the actual economics, the official studies on these promising results?
Kinross has flagged Q1 2026. That's when they plan to give comprehensive project updates, including the economics for Phase X and also for Bald Mountain Redbird Phase 2 and the Curlew project. So yeah, Q1 2026 will be the next big data point analysts will be watching closely to update their, long-term models for the company. And just quickly on Curlew, the infill drilling there also continues to show really good results. High grades, good mining widths, supporting the resource. They mention assays like 2.1 meters at 22.3 grams per ton, true width. Very high grade.
Very high grade indeed. Okay, finally, let's just briefly touch on the non-financial side. Sustainability, social responsibility. How did Kinross stack up across its global operations this quarter?
Yeah, they highlighted quite a few achievements, showing a pretty strong commitment across their diverse portfolio. It really emphasizes responsible management as core. For example, in Brazil, their huge tailings facilities at Paracatu, they received the top-level AA classification for management and monitoring. That's a major independent thumbs up for their safety and operational practices, especially in a sensitive area like tailings.
And recognition in the U.S., too, for land stewardship.
Absolutely. Out in Nevada, Bald Mountain got the Nevada Excellence in Mine Reclamation Award for earthwork. That's actually the 5th reclamation award that site has won, so it shows a really consistent focus on cleaning up and rehabilitating the land. At the same time, over in Chile, La Coipa achieved ISO 50001 certification for its energy management systems. That confirms they're using global best practices for energy efficiency in their operations.
And supporting local communities, infrastructure.
Yes, the sources noted specific progress on local education infrastructure over in Mauritania. They completed 17 fully equipped classrooms. It just underscores that these ESG principles, these responsible mining ideas, are being actively put into practice as part of how they do business everywhere.
Okay, so what does this all mean? Wrapping up Kinross Gold's third quarter of 2025, it really painted a clear, powerful picture of a company executing really well during a very favorable gold cycle.
Yeah, it's almost a textbook example of using the cycle effectively. They absolutely executed their strategy, capitalized aggressively on that high gold price, which, as we saw, led to record cash flow and that massive strengthening of the balance sheet, getting into net cash. And that financial firepower immediately turned into dramatically higher returns for shareholders, bigger buybacks, higher dividend. But crucially, they didn't seem to take their eye off the ball for the future. They maintained critical momentum on those key long-term, high-grade projects like Great Bear and Phase X. Those are the things that underpin their production profile for the next decade.
Right. Now, for you, the listener, maybe something to think about going forward, a provocative thought. Kinross's Q3 success was, let's be honest, heavily fueled by those high gold prices, which easily covered the higher royalties and other costs. But the source material specifically pointed out how sensitive their costs are to currency swings. For instance, just a 10% change in the Brazilian real. That apparently shifts Paracatu's production cost by about $45 an ounce.
That's a big swing. And it raises a really critical, maybe nuanced question for Kinross's future profits and those amazing margins they just posted. Look, they can't control the gold price, right? But management does have to navigate these exchange rate risks in places like Brazil. So the key external factor for you to explore going forward is maybe this. Which element will be more crucial for Kinross maintaining those record, $2,310 margins we saw? Will it be continued gold price strength? Or will it be more about controlled currency volatility in those key operating countries? That might be the tighter metric to really watch over the next year.